welcome to this, the first in a series of ICMA's webcasts on savings, investment and NBFIs, otherwise known as non-bank financial intermediation. My name is Nicolette Moser, and today I'm speaking with Bob Parker, the Senior Advisor to ICMA, and together we will be introducing the topic of NBFIs. So what is non-bank financial intermediation? While not the most helpful of labels, NBFI basically refers to financial activities which are similar to those provided by a bank, but are performed by other financial entities. NBFIs play a crucial role in the financial system by providing funding, liquidity, and alternative sources of credit and investment. While not always well understood, NBFIs can provide an important and positive contribution to the functioning of markets. And the purpose of this webcast series is to explore different examples of NBFIs, explain what they are and what they aren't, and hopefully provide a better general understanding. In today's conversation with Bob, we're aiming to provide an overview of the NBFI universe. So Bob, welcome. NBFIs provide a wide range of participants across a broad spectrum of activities. Could you tell us a little bit more?
As you say, Nicolette, the NBFI market covers a whole range of market participants and investors. So I think point number one is that diversity of investors and lenders, and I think point number two is therefore it is quite difficult to generalize, but you can actually break down NBFI activity into a number of subcomponents. And, I would start just highlighting long-term investors, whether those be pension funds, insurance companies, sovereign wealth funds are an increasing and large part of NBFI activity. And then we go on to the second component, which is specialist long-term investment funds, whether it be investment funds for real estate, for private equity, and an area which has seen recently very significant growth, which we'll talk about more of, which is infrastructure investment. Then, apart from those longer-term investment participants in the NBFI market, we also have to highlight also more liquid activities or more liquid areas of investment, whether those be the ETF market, which is now in excess in volume relative to active traditional asset managers, obviously mutual funds, hedge funds, and then increasingly specialist funds which are focusing on shorter term lending and an alternative to short-term bank finance. So it breaks down into long-term investors, specialist funds, and then more liquid funds such as ETFs, mutual funds, and short-term lending funds. So that's the broad spectrum of NBFI participants.
So given that there are too many types of NBFIs for us to cover in this one conversation, perhaps you could elaborate a little bit more on the range of financing that these NBFIs can provide.
Absolutely. I think the first point to make is that long-term investors, and I mentioned pension funds and sovereign wealth funds and insurance companies, they all have long-term liabilities. And if one looks at a typical pension fund, its liabilities can be sort of 30, 40 years. With a sovereign wealth fund, in many cases, and particularly those very large sovereign wealth funds, it's actually very difficult to quantify the duration of their liabilities. So consequently, for those longer term investors, they don't need liquidity and they want to invest in real assets. And whether that be in the corporate sector, whether it be in infrastructure, whether it be in real estate, whether it be in other long-term real assets, which provide, if you like, a match for their longer-term liabilities. And similarly, I mentioned the specialist funds. So, an area of growth recently has been infrastructure funds, and infrastructure traditionally has focused on its sectors such as investing in transport, whether it be freeways, motorways, whether it be the train sector, whether it be airports. It's invested in the energy sector. And more recently, infrastructure obviously has focused on sectors such as, healthcare and the whole range of technology. So those are the sort of the longer term areas where NBFIs are investing. And I make this very clear distinction between investing and lending. And if one looks at those shorter term or more liquid funds that I referred to earlier on, areas of activity are trade finance, short-term lending as an alternative to bank lending, leasing, bridge finance, whether it be the hedge fund market or these specialist lending funds. Frequently they are providing finance in the M&A market, and one shouldn't forget a very important area, which is not new. This has been around for a good 30 years or so, which is the high yield market, the distressed debt market, and in periods of economic stress, restructuring, which is obviously linked into distressed debt. I think one other area I would just touch on is the NBFI activity that we are seeing in the insurance market. And increasingly we are seeing a number of specialist funds which are providing insurance and treating insurance as an asset class. So it's not just an alternative to banking, it's an alternative to other financial sectors, and I mentioned insurance as one example.
And so why do you think that NBFI activity has grown so rapidly?
I think one factor is that we can't ignore the fact that over the last sort of 20 years we have seen a range of financial crises. Whether that was the banking crisis and the financial market crisis of 2007 through to 2009, whether it was the range of serious challenges that we had in the Eurozone. And let's not forget that a number of countries, such as Greece, Cyprus, Portugal, had to have their debt restructured. A number of banking markets again had to be restructured, and particularly the Spanish banking sector went through a difficult period of restructuring. And then more recently we had the shock of COVID, which was a major shock to economic activity and particularly to supply chains, and that was very disruptive indeed. And following on from COVID, we have had the period of high inflation, the rise in interest rates, and recently, obviously, one major positive development has been the control of inflation, and with central banks starting, and I emphasize the word starting to reduce interest rates. So I think the background to the NBFI market has been this quite long-term period of up to 20 years of a series of financial shocks. Now that's resulted, I think, in two considerations. The first consideration is investors wanting to diversify away from placing deposits with banks and moving into, whether it's money market funds at the short end of the yield curve, or whether it is the longer term investment trends, which I have touched on. So investor diversification has been one factor. I think a second factor has been investors running quite high levels of savings. So, if we look at savings rates in Europe and the UK and Asia, savings rates are at a very high level, and with central bank easing throughout most of sort of 2010 onwards until the tightening in interest rates facing inflation recently. We've had very high levels of liquidity in markets, and that's obviously been backed up by the quantitative easing programs that we had from the major central banks, and really until 2022. So high levels of savings, high levels of liquidity, a series of financial shocks. That has resulted in increased investor and lender activity outside the banking sector. I think one other factor has been overall the low level of interest rates offered by the banks relative to alternatives in investment markets. So investors have been attracted by the more attractive returns outside lending to banks.
So, Bob, in the EU, we're seeing the investment, the Savings and Investment Union, and in the UK, there's been the recent government's International Investment Summit. So there seems to be a focus on private finance to drive economic growth and to fund climate goals and digital transition. I mean, would you agree?
The answer to that is absolutely yes. And if one looks at the state of the global economy at present, and this was highlighted by the IMF recent report on global government debt, which it now estimates at over $100 trillion equivalent. We're in a picture where not just in Europe and the United States, but also across a range of other economies, including sort of Japan, India, and China, where debt to GDP levels are high and have risen significantly in the last few years, and where also budget deficits are high. And just to sort of highlight that, the American budget deficit, irrespective of the outcome of the American presidential election, that budget deficit in 2025 will be in excess of 5% and potentially as high as 6%. If we look at recent budgets and the upcoming budget that we have in the UK, the budget process that we're seeing in France at the moment, the process is one whereby governments are now having to face that problem of high levels of debt. So the overall picture is that governments, to boost growth, are increasingly reliant on private sector financing and cannot rely on traditional fiscal easing. So the problem, I think, for governments is that they need to mobilize private finance. To mobilize private finance, they are very much reliant on the development of what we call the NBFI market, and they need those longer term investors, less so the shorter term liquid part aspects of NBFI, but certainly the longer term investment aspect of it.
So what are the advantages of NBFIs?
I think a number of factors. I think factor number one, I mentioned that we have in Europe and actually in most Asian countries as well, very high levels of personal savings. And for example, in the UK, the savings ratio is currently running at about 10%. In the Eurozone, it is running actually close to 15%. Asian countries historically have run very high levels of 20% plus savings ratios. So I think advantage number one is the mobilization of those savings. And I think it's a truism that if those savings are just left under invested or are just put into short-term bank deposits, frankly, there can be a much more useful use and mobilization of those savings. I think a second factor, and here we see very significant differences between the European Union and the States, which is the use or the mobilization of those savings in capital markets. And one comment that is repeatedly made by European finance ministers and by Brussels is that as part of the objective of capital markets union, or what is called savings and investment union, we need more savings into capital markets, and that is very much the case in the United States. So you've got this big difference between the States and Europe, and the argument is that with a more efficient mobilization of savings, that should translate into a higher level of longer-term economic growth. So factor number one, mobilization of savings. Factor number two, that should result in higher economic growth. Factor number three, that should result in more efficient and more liquid capital markets, which in turn will loop back into more positive economic growth. I think another factor is that for investors, whether it be Asia, Europe, or the United States, they want a more stable, secure economic and capital market background. And if we have more developed capital markets, and this is very clearly an objective of the UK and EU governments, then that will be a more attractive investment environment for retail and institutional savers.
Now, what do you see as the risks arising from market-based finance and investment? And in your view, is the increased scrutiny and enhanced regulatory regime appropriate?
Well, I think there are two considerations here. The first consideration is investor protection. And then the second consideration, which a number of central banks and regulators have focused on, which is systemic risk. And linked into systemic risk is obviously contagion risk, i.e., if we have a problem in one capital market, say in Europe, does that then rebound across global capital markets? But I think, just on the first issue of investor protection, I think it's fair to say that since the financial crisis of 2007-2009, very significant positive regulation has been developed to protect investors, so that investors, whether they're going into a mutual fund, whether they're going into a longer term investment fund, increasingly, there is transparency of the risks that those investors are taking. I think there is transparency, particularly of, what are the risks of an investment going wrong. And I think in addition, there is much better regulation of the asset management industry, which in turn, today compared with, let's say, 20 years ago, I would argue, and I accept that I have a degree of bias here, but I would argue that the asset management industry has made very significant progress in improving its internal risk management systems, and that covers everything from market risk to counterparty risk to liquidity risk, and the other range of risk factors. So, investor protection, it'll never be perfect, but I think major progress has been made. On systemic risk, here I think that there is need for greater understanding of what systemic risks can occur in NBFI. And in longer term investment risk, where investors such as sovereign wealth funds and pension funds and specialist, for example, infrastructure funds are investing in long-term illiquid assets, there could be a problem with those individual assets, but I think contagion risk, and this has been clearly demonstrated over the last 10, 20 years. I think contagion risk and systemic risk from long-term illiquid assets is very low indeed. On the more liquid side of the market, Clearly, there is this transfer of risk from banks to investors. And I think the major contagion risk is what happens if you have a market, what I would call a market panic. Investors are selling assets very quickly, and investment funds, whether they be ETFs or mutual funds, have the challenges of meeting those investor redemptions. Now, the asset management industry and regulators have put in, a number of protections, whether it be side pockets, whether it be temporarily closing funds, to address that market volatility. Market volatility is never going to go away completely, and arguably market volatility in certain cases is a positive factor, and it's a function of liquid markets. And investors, the asset management industry, always has to give investors that option of redeeming their assets. So one has to be realistic here. I would argue that systemic risk, as it has transferred from the banking market to the asset management industry, actually is now more contained and more controlled than it certainly was in the period prior to the financial crisis of 2008.
Thank you. And for my final question, Bob, how do you envisage the market developing over the next 3 to 5 years?
I think a number of considerations. The first consideration is what do governments want, and will they encourage the NBFI market? And I think the answer to that is yes, and it comes back to my earlier comment that budget deficits, government debt, though are under quite significant pressure. That pressure results in a demand for mobilizing private investment and private savings. So the government environment, the background of what governments want, I think, is one positive factor. The second positive factor, and we've seen this in recent IMF reports, which is that we have to recognize that after all those financial crises and shocks that I described earlier, consumer confidence and savings confidence is still fairly fragile. That fragility leads to higher savings rates. Those higher savings rates are being mobilized into asset management and investment markets away from the banking market. So, that is a source of growth. I think a third factor is the increase in liquidity and the broadening of capital markets. Arguably, we already have that in the States. And will US capital markets broaden further? The answer is yes, but probably at a slower pace given the size of their capital markets already. But in Europe, there is a lot of work to be done, and this is well recognized by Brussels and individual governments, and outside the EU in the UK, in broadening capital markets. That broadening of capital markets has a number of advantages, which are linked to the need to boost economic growth, and that in turn results in a need for the development of the NBFI market. One comment I would make finally is I would urge everybody to think of an alternative to the name NBFI. And I think there are a number of factors which suggest that the phrase NBFI is frankly not particularly appropriate. So for those of you who are watching this webcast, please can you liaise with ICMA and come up with some intelligent alternatives to a phrase that frankly I don't like. And I'm sure there are some very good alternatives which the viewers of this webcast will suggest to us.
Thanks, Bob. I know that a lot of great minds have been sitting around trying to come up with an alternative to non-bank financial intermediation. But thank you, Bob Parker, for providing such a comprehensive overview of NBFIs, and it hopefully this will help with the understanding of what an NBFI is. And also many thanks for joining me in this first in a series of ICMA's webcasts on savings, investment, and NBFIs. Thank you,
Many
Bob.
thanks. Thank you. Thanks. Thank you.